Hi, I'm Gaalen Engen from EQUITY.GURU, and I'm here to give you my 3-minute beat on EBITDA. So, what is EBITDA? It's an important, often misunderstood and abused financial metric that can be found in a company's income statement. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Interest expense on debt is left off EBITDA because it depends on the financing structure of the company, and each corporate structure is different. Taxes are excluded from EBITDA because they vary by jurisdiction. Depreciation refers to the decreasing non-cash value of assets like property, equipment, and facilities. Amortization refers to the expensing of non-tangible assets like copyrights, patents, trade names, goodwill, etc. These cost totals are subjective and dependent on historical investments, not on the current operating performance of the company. Therefore, they are also excluded in EBITDA. EBITDA can be used by analysts and entrepreneurs to calculate a company's valuation for merger and acquisition purposes. Financial institutions use EBITDA to calculate a company's ability to make debt payments, as well as to create a benchmark for debt covenants. EBITDA is also used to compare the core profit and potential of two different companies in the same industry, especially when they operate in different tax jurisdictions. However, EBITDA is not a GAAP or generally accepted accounting practice metric. Since it isn't formally standardized, it's open to interpretation as to what costs to eliminate and what income to include. This can result in misleading financial statements like WeWork's IPO prospectus, which did not include general and administration expenses in their EBITDA. In short, read the small print on the company's income sheet to see exactly how they arrived at their EBITDA number. Typically, you will find EBITDA calculated like this: net income plus depreciation, amortization, interest expense, and taxes. For instance, ABC Incorporated brought in $283,935.52 in net income. The company reported $12,356 in depreciation and amortization, $11,498 in interest expenses, and $38,718.48 in taxes. The resulting EBITDA would be $346,508. So, what is a good EBITDA? Well, like operating cash flow, the higher the number, the better. But unlike operating cash flow, EBITDA can be distorted on an accounting whim, showing a much higher number than the company is worthy of. So, even though there has been an increasing emphasis on EBITDA since its inception in the 1970s, it is a hotly debated metric in terms of its reliability and usefulness. Trading icons like Warren Buffett, head of Berkshire Hathaway, said EBITDA is not a meaningful measure of performance, as depreciation is a real cost that should not be excluded. In the end, judging a company's performance solely on its EBITDA potentially puts your portfolio at risk. Use EBITDA alongside other GAAP-recognized metrics as a comparative analysis. This should give you a truer picture of a company's worth and growth potential, making for a safer investment. If you'd like to learn more, join our channel here on YouTube, or come visit our website at equity.guru and become part of the family.